Okay, let's get started with the panel. I guess we'll go down the line. Everyone kind of introduce themselves and talk a little bit about the firm, and then we'll get to some questions. Bo.
Great. My name is Bo Busker, and I'm the founder and managing director of Arkstone Partners. In the late 90s, I was a private equity investor. In the early 2000s and mid-2000s, venture capital investor. In 2006, I founded Arkstone Partners, and in 2010, founded Arkstone Equity Research, which is an affiliate of Arkstone Partners that conducts private equity institutional class research on private companies.
Thanks.
My name is Howard Leonhardt. I serve as the founder and chairman of the California Stock Exchange. Back in 2008, we took our company BioHeart, BHRT, public, the only biotech IPO of the year. We raised $6.5 million, and it cost us $4.8 million in legal costs, accounting costs, printing costs, travel costs, roadshow costs, to raise that $6.5 million. My first reaction was to fly to Washington and start punching people. But I decided that wouldn't be the best idea, so I started to circle some friends that had knowledge of problems in the capital markets, including David Wield, who you just heard, and put together a plan to develop a better stock exchange. We want to start with private companies, helping them through every stage of financing with available tools that are legal now, and then we're gearing up for crowdfunding when that hopefully becomes legal soon.
My name is Boaz Rahav, and I'm the co-founder of Greencrest Capital. In the mid-90s, I introduced one of the first specialized index fund companies in the world to offer an alternative to, at the time, was traditional way to invest. Later, it became a market of ETFs, but it's probably the fastest growing market today. I co-founded Greencrest about a year and a half ago with the realization that there is a new asset class in creation, which is the private stock or the secondary direct, where investors can buy into private companies directly without going through VCs or private equity investors or managers. What we recognize at Greencrest, that the market is missing a hub or a platform that will allow them to gain insight, mainly through research, to understand what they invest in, to have the ability to have access to high quality research, to understand valuations, to understand trends. Many times investing in private companies through the secondary markets means that you don't have immediate access to financials. And we try to solve that problem. Over the last few months, we released or we announced two major partnerships that we have at Greencrest. One is with Nomura Instinet, that sells our research to institutional investors around the world. And the second is with Knight Capital, which is the largest independent market maker in the US. And that partnership is to introduce a new level of liquidity and a new level of trading availability into leading private companies.
Darren, David, thanks as always for having me here. And again, as we said earlier, it's been great to see how this movement, not over a year ago, has really grown in size and scope. So thank you. I'm Vince Molinari, CEO and co-founder of Gate Technologies. We set out in late 2009 to address a lot of the things that we've heard about today. And David Wield, just like a lot of people sitting here, has been a great inspiration. And his data and information has served as a great body of work for us to analyze and look at the marketplaces, look at the market evolution across the spectrum, not only domestically, but globally, what that's occurred. We set out with the vision in late 2009 to create a new market infrastructure. And our belief was, as we do have private companies that are emerging and solution sets to the broken IPO system, but really ways to drive capital formation back to the private sector, back to the private company, back to the entrepreneur, because that has been the engine of growth in our country and our economy that we felt could be the sustainable fact to recovery and future growth. And by doing it with technology in a regulated manner as a broker-dealer, and then moving to the ATS model and the qualified matching system for limited partnerships, allow us to look at the environment and the problems of today with new lenses and the lenses of how to apply technology, try to have some changes in regulation to foster this growth, and doing it in a fully transparent manner to create liquidity and capital formation. So love to talk more about it as we go, but thanks for being here today.
Thanks.
We have come a long way, I believe, but we've got a long way yet to go. The Goldman offering was really a watershed experience. It brought to the public a much more. It became very real. The secondary markets became very real to the public at large, and since that time, there have been a number of things that have been both very positive, but also some other things have been very frustrating for the private company market, generally speaking. Positive events would be the addition of new tickers to major stock exchanges, where companies that had been private before had been trading in the private company market and had now sort of graduated up to the public markets. Those companies are certainly noteworthy. Other companies that are listed now that were not 1 year ago are Keating Capital and GSV Capital, which was mentioned before, Michael Moe's fund. Both of those listed in 2011, and those are also significant because those are publicly traded entities that have the majority of their holdings are private company stocks. So it's another expression of interest in the private company market. One of the things that I think certainly I am keeping a close eye on is the emergence and the sort of the rays of light I'm seeing in terms of information transparency and the emergence of private equity research firms like Arkstone and like Greencrest. They are increasingly accepted. It is a hard row to hoe to be a private equity investment research firm, and so the successes that both of our firms have enjoyed in 2011, I see as a very very good thing. And again, we have a long way to go there too. Gaining the attention of the regulators has been a positive, and I'm very pleased to say that we've seen non-antagonistic legislation happening, as opposed to what I would have predicted 12 months ago.
Right. I think that was the biggest surprise.
Absolutely, yeah. So, and then finally, the main point I think I have is that the deep pools of capital, the institutional investors that amass the greatest wealth in the country, those mutual funds and hedge funds that everyone knows by name, are actually attracted to this company. I believe the reason for that is that the IPO allocation isn't necessarily the game anymore. Classic stock pickers are attracted to the private company markets because the lift in value is happening before the public offering, and I think that realization that was brought forth in that watershed experience when Goldman brought Facebook out in the sort of tail end of 2010, early 2011, really underscored that.
Yeah, thanks. And I guess, just we had, Patrick McHenry obviously opening up the day and talking a little bit about 2930. But Vince, you've been, expert congressional witness and have been kind of on the Hill, informing these guys about the markets for a while now. You want to talk about some of the other bills and how they'll all impact the market too once they're passed?
Absolutely. Hopefully when they get passed
right.
through Senate. But I think touching on a bit of Bo's tail end of the statement, I think the biggest issue that has come forth in the past 12 months or so, if we were having this conversation a year ago as we were, not a lot of people listening, and the biggest question was, what was Capitol Hill or what was the SEC reaction to the space going to be? Which way was the pendulum going to swing? Was it going to be shut down, really putting it in more, I would say, controls than needed, or more regulation that was needed on it? So I think the biggest vibe that we're getting, if we can use the very technical term in vibe, is that the work with the SEC and in Capitol Hill is certainly indicating that they're not shutting down this market. They're beginning to understand that it's not just about the Wall Street firm not making money on the IPO, it's that we've got a fundamental problem in the country. And we need to get capital formation back into the system. So they're better understanding that there's a cause and effect, and we can approach this in a different manner today. So I think very clear to us that the SEC is not shutting down the space. It's a question of how much they're going to allow it. And the same with Congress. And I think you've seen some great introduction of bill. And I said it a little bit early with Congressman McHenry. It takes leaders to stand up in an early phase to spearhead the initiative and take some hits. But he understands what market infrastructure is and understands the problem and how we have to fix it. I think you have Congressman Schweikert, very similarly, out there on the 500 shareholder rule. And we think that's really important legislation that unfortunately didn't get passed through the House. And I think it actually didn't get voted on in the House yet. And I think we have a number of bills that were in the House, including Congressman McCarthy's solicitation ban removal, Congressman Finch's 404 on Sarbanes-Oxley reduction, getting kind of commingled, so you kind of get a lot of constituents and other members of Congress on both sides of the aisle, they get confused of how do you got crowdfunding over here, you've got solicitation ban, you got Reg A over here, you got 500 shareholder rule. So I think in the first phase in Congress, it was a smart move to move at least the first four through when you start to look at Reg A, and Reg A being very meaningful and moving from 5 million to 50 million in capability. Schweikert's recommendations in moving to 1,000 shareholders of record from 500, but more importantly, how that's being measured. Right. And his proposals, originally for the exemption for accredited investors that got knocked out, and at least now the employees are in that headcount. I think the next phase is really great folks like Senators Toomey and Corker coming out and trying to have some movement on the Senate side. A lot more resistance, as we heard about today, whether it's dysfunction of bipartisanship or, frankly, election cycle. But kind of shocking that something like McHenry's bill didn't fly through Senate when you have someone like President Obama also backing that. Right. So it's going to be interesting. My guess is if we don't have some real movement in the next 60 or 90 days, we're going to be in full election battle cycle, and it becomes a 2013 issue. But I think the biggest story is that with a regulatory framework of broker-dealers and looking at broker-dealers and ATSs and technology in a different manner, we can approach great things in crowdfunding in a platform that could be extended and start to use equity formation as long as you're using current regulation. It doesn't allow for some of the things that are out there today, doesn't allow for the full outright solicitation, but we're getting there. So I think it's a cautiously optimistic question of when, not if.
So do you think this is the year that we're going to see at least some movement on Capitol Hill, or you think they're still going to drag their feet?
No question there's movement and the recognition, and again, going back to some of the great things that David Wild has been talking about for a number of years that are catching fire, that's inspired folks like us at Gate Technologies to understand some of the data better. And I know some of the other participants here and many others. So it is that grassroots movement that has gotten movement. Whether it ultimately culminates in full passage this year, yet to tell.
Great. So there are many people that believe that with the private company markets, we're witnessing the embryonic period of the next great stock market. I'm definitely one of them. And this question for you, Howard, what similarities do you see with the between the emergence of this new market and the appearance of NASDAQ 40 years before us?
I do believe that we're undergoing some fundamental changes, and I listened to David and talk about the model of bringing back brokers with the telephones and that stocks are sold, not bought, which I agree with. But I differ a little bit with David that I do believe that he's underestimating the power of social media. And I think the storytelling where he talks about a broker telling the story to a buyer, I think that's going to be replaced with entrepreneurs making videos, going to personal meetings, and using the crowdfunding platforms as the replacement of the former boutique investment bank. But also, in our stock exchange, we're talking about nurturing companies from seed formation, providing tools to become better entrepreneurs. Business plan optimization, we're aligned with EquityNet, which analyzes 40 different parameters for enterprise success survival, reports that in research to potential buyers, and then we take them all the way through, and we plan not to let them go. The old model, even NASDAQ at their best, didn't do that. I think we're entering a new age, the combination of social media and mentoring and nurturing businesses from early stage all the way through IPO and aftermarket support.
Oh, that's great. That's great. I definitely think that's what the market is needed. Actually, Boaz, this question is for you. In December, you guys at Greencrest announced a joint venture with Knight Capital, which is the largest market maker in the U.S., and that basically enables Knight to offer institutions access to trading in shares of some of these leading private companies. Could you discuss a little bit more about this partnership, and especially, what is the impact on institutional trading, the market making, the whole universe? And do you think this is the first step towards actually making markets in some of these pre-IPO companies?
Sure. The partnership that we announced in December, about a month ago, with Knight is, of course, it's a major thing, or it's a major development for Greencrest Capital, but we also think it's a pretty significant improvement or advancement for the market as a whole. It pretty much, what it states is that the investing in private companies, buying directly into private companies or buying the company stock, it become a valid asset class with true legs, where institutional investors are looking for means to generate alpha by somewhat minimizing their dependency on outside managers, but doing it themselves. We see anywhere from Boston-based mutual funds to New York-based hedge funds. They feel confident enough that there is enough alpha, there is enough opportunity buying into private stocks as companies stay private longer. On average, we look at the statistics, we track trends and historical statistics here at Greencrest, and we just came to realize that successful private companies, technology companies, used to spend 4 years in the private domain before they became public. Currently, the average duration, so to say, or period of time it takes a successful private company before they go public is over 10 years, which is pretty remarkable. So that period of time has mushroomed, actually more than doubled. What it creates several kind of side effects. The first side effect is that VCs are not designed and are not built currently to hold a position for 10 years. They are just not designed to do that. So those VCs, A round, B round, not to mention angel investors, they need to seek for liquidity solutions. So the institutions need liquidity. It's not just the rank and file. We think about people selling Facebook shares. It's not the VP of marketing, or it's not that associate from whatever department it is. All of a sudden, it's the A round, B round investors that get to a point when they have to realize liquidity. So this is one trend. The second trend that we see, that institutional investors, of course, while minimizing their dependency on outside managers, they still understand that one of the greatest innovations in this country is technology. And everything that Silicon Valley represents is an alpha opportunity. So what do we see is an opportunity, from one hand, to provide liquidity for institutional investors, and on the other hand, to provide investment opportunity for institutions that are looking to invest in companies potentially 1 year, 2 years, 3 years prior to a potential IPO. With Knight, what we did, we team up with the largest market maker in the US to create an independent platform that will allow institutions on both sides to seek for liquidity for their positions and allow those to meet. The opportunity with Knight is of such that we think that the ecosystem is changing. And everybody that you see here today probably will be very busy in the next year, 2 years, 3 years as the market dynamic change. And investing and seeking liquidity in private positions is becoming more and more popular.
Great. And Bo, kind of on a related question to that, do you want to talk a little bit and address maybe some of, well, first from a research standpoint and transparency, how basically you guys are really helping the institutions that are getting involved in this market now, the T. Rowe Prices, the Fidelities, the small cap buyers, and maybe you could touch upon who are some of these buyers that are looking into some of these pre-IPO companies and how research is sort of changing it by bringing it back to the market.
Certainly, the buyers I would characterize as again, the deep pools of capital are very interesting. A lot of those have fully built out research departments. They're not specialized in the private company market. So they may have an investment thesis where it comes to why they like Facebook or Twitter. They may not fully comprehend the sort of the venture capital lead up and the sort of all the nuance that goes along with a private company transaction. So there's one type of buyer. Another type of buyer might be a sovereign wealth fund, of which we have several clients. And those need more of everything. They come to us for an outsourced due diligence group, essentially, or department. And soup to nuts, everything from understanding the private company markets to the specific company, to the investment thesis, and allocation tables and waterfalls and breakpoints analyses and things like that. So those are the more serious buyers that we see. There are a number of pretenders out there, and they would tend to be essentially broker dealers that are associated with other broker dealers that are associated with other broker dealers that eventually lead to a buyer or a seller, which is probably a member of the deep pool. And those are clients that we serve on the buy side. The one thing I will note on the time horizon, that 4 to 5 year time to liquidity was not normal. That was 97 through 2001. I was an investor during that period of time. It was anything but typical to have a company that started in 1 year and go public 3 or 4 years later. We're seeing a little bit of that now, but the difference is that those companies that were going public then had no business being public. So I take issue with some of those measurements. The 10-year horizon, though, is for real, and that's normal now, and it was normal before that narrow window in the late 90s during the boom. So I do believe that's a material problem. I don't believe we should be looking back to a time when companies only lived for 3 or 4 years before going public as something that approached normal.
Well, it's interesting that you say that, but then you take, it took Microsoft 15 years to do $1 billion in sales. It took Groupon less than 3.
Right.
So,
Yes.
There's the difference with technology.
Huge change in the way that companies are working. And to one of my colleagues in the business, I was recently talking about that disconnect, the pace of innovation that is happening now, and the time to revenue and the time to earnings is on fire, and yet the time to liquidity is going the opposite direction. So there is that disconnect for sure. And so the way that we see it is that there is a period of time where early stage specialists are welcome in the company, both as managers and as investors. There are Eldorado Ventures on Sand Hill Road, great early stage Series A only firm, been like that for fund after fund. They're probably on fund 12 or so by now. And they're looking for an exit in a shorter time frame, just like an early stage CEO or a startup specialist, a founder that's a serial entrepreneur, is looking to exit after a couple of years, after the company starts to lift off. So this private company market, I believe, is going to serve a critical role in returning capital both to those entrepreneurs so that they can have the freedom to go on and start their next thing, and also the freedom to those Eldorado Ventures of the world that are looking for the exit in less than 10 years.
Great. Now, Vince, this one's for you. We heard David we'll start to talk about the spreads. And, obviously they've diminished and almost disappeared in the public markets, but now with Facebook and a lot of these higher profile companies in the private markets, they're back. And it's actually, we're seeing it's driving a lot of people back, they're gravitating towards this market. Do you think that this could, because of, we could start off now with the spreads, that this could be the revival of, small cap research, small cap stockbrokers, and how do you see the elements of that, once great ecosystem making a comeback?
Well, I think after getting past the first dose of depression after listening to David again, it really points to the opportunity when you go back to the half full glass. And I think it's really, for us at Gate Technologies, it's about new market infrastructure creates new investment practices. And we've heard a little bit about it here. What is it really about? It's new ways to capture alpha. And what we've seen and what's been very clear, and I think Bo touched on this a little bit earlier, the big bellwether of having Facebook has woken everybody up that the alpha creation, that enterprise value creation that we're accustomed to in the IPO happened much, much earlier in the cycle, much in a different manner. So as we've been looking towards at Gate, we believe this was going to migrate to an institutional following. And when you have huge, deep pools of capital looking to chase, how are they getting that return? We don't transact directly with the high net worth individuals because we believe that is puts us in competition with the other broker-dealers, and we want to be that neutral utility in the middle. But I think when you start to really look at the framing of a new market infrastructure with a new ecosystem, we look at what's worked in the institutional markets and what didn't work. So we look at having full bids and offers, indications of interest, depth of market, so you can have comfort in what you're buying and selling, what those markets are looking like, not just a phone brokerage side. I think when you look at some of the social networking aspect and disseminating that information out to the marketplace, you're really taking new infrastructure and laying it with proven practices of settlement and disclosure and putting that into the framework of a regulatory body, I think becomes the new market infrastructure. I think when you take that further out and look at if it's the stockbroker having a rebirth, I think that stockbroker has a rebirth in coming back to its customer with a product that they're relevant with. Mm-hmm. As our traditional markets have become so commoditized and they've really become trading market environments, and we can talk about the percentage of algorithmic trading and how many thousands of a trade do we do in a nanosecond for scalping XYZ. We moved away from the investment practice. And I think what was very attractive about the private company marketplace is you're really speaking to investors, and investors who are believing in that company and wanting to further enable it. And I think, again, if you go back to some of David's charts, forget the $25 billion company. You're really reaching down much further to the people who have a belief system in helping that company grow. So I think when you go back to that stockbroker reinventing himself, their customers are going to start to do this business with somebody because everybody's heard about Facebook, Twitter, LinkedIn, et cetera. When you move that down a level to the next 500,000 or 10,000 private companies, there's opportunity that we have to bring forth. And I think that goes to the next layer, and Greencrest and certainly Arkstone and Michael Moe, and coming out with early research on private companies is the part that we really need in the ecosystem. What are you buying? How are you buying? It's not just about Facebook because everybody's comfortable because there's 100 million users and they know what they're getting. How do you make that a sustainable investment practice at the next level? We call it actionable knowledge. Every investment decision, whether you're that retail investor, the portfolio manager, the hedge fund, is a piece of information that you're processing that's saying, I like this, I don't like it, I want to buy it, I want to sell it, or I want to do nothing. So the more that we can propagate new market infrastructure with more parts of the ecosystem that has information and research, I think is really going to be the game changer. And I think that's going to be a bottom up. As more investors are demanding information, the traditional firms are going to start to put in that research department that's covering private company with that, and I think they become profit centers again.
I think it's interesting. You also touched upon something too. In the public markets, you're not a company, you're not a business, you're basically a symbol. And, if you could talk to a lot of investors, they only want to know what's the symbol so that they could check out, basically what the volume is. And that's, they make their decision based on that, and they're not making their decision at all based on fundamentals. So, and Howard, this is for you, because you bring really a unique perspective, because, you come from also, with the hat of actually going through the process, taking a company public. And, it's an interesting story having you say, raising $6.5 million, 4.5 of it basically went to funding the actual process of actually doing that. So for, how do you see, this marketplace, how do you see this marketplace different, and even from just wearing the hat of the entrepreneur, and forget about the legal fees, but basically, how would you make a difference if you had the opportunity to actually do, a primary transaction on the private markets or raise capital here?
Michael, who sat next to me a few moments ago, he brought up the problem is fundamental that for retail demand or demand for stocks, and no matter what we show on the charts for the problems to get to an IPO, the buyers are maybe not there. And our entire economy has had a loss of confidence, investor confidence, consumer confidence, job loss confidence, that has all gone in the wrong direction. Mike also used the term prime the pump. I really believe that a stimulus for small company job formation, which starts putting people back to work, starts people feeling comfortable to spend, and starts a movement of optimism, and then coupled with all of this that we're talking about, modifying the capital markets, crowdfunding, is somehow making a massive reach out to compel people that maybe have never invested before. The data shows about 60 to 90,000 angel investors that are investing in early stage companies out of a population of 350 million. And I would broaden the pool much larger than that. We would like to see people that are seeking immigration visas into the U.S. to get points if they invest in companies in the U.S. that will accumulate and speed up their application if they've made a lot of investment in the U.S. before they've made an application. We'd like to see the monies that are frozen by corporations in tax havens overseas to have a tax-free return to the U.S. if they invest in our companies. There are many innovative tools, so we have to work as much on the demand as the supply. The supply would be creating capital for these companies, but also spending time on the demand side. Part of that is just leadership, get somehow compelling people to feel like they should invest long-term in small companies, and part of that is the idea that they're going to have some place to go with that it's going to go up, and then there's going to be market support structures they can provide a return, receive a return.
Great. And Boaz, this question's for you. Just talking about IPOs a lot today in the conversations, you may have heard some whispers about a little company called Facebook looking to do an IPO. Well, how do you think that's going to impact both the private market as well as the public market? And do you think, we've seen LinkedIn, basically their IPO was pretty successful. I mean, I was thinking, we're 1995 all over again, and then, Groupon and Zynga kind of, shot us down. What do you think about, Facebook in the public markets, and also how do you think that's going to affect the private markets as well?
It's actually interesting that you mentioned Facebook when you talk about private companies. We expect the IPO to be, I wouldn't say the IPO of the century, but a very substantial event for so many dimensions. Probably, when you will, agree, Bo, and when we look at the valuations, probably going to be at a $100 billion range, give or take. And we can, leave the discussion whether it makes sense or not, to the experts. And not today. But at $100 billion valuation, IPO, that will immediately buy the company the right to be included in pretty much every benchmark around the world. Right. And you don't see IPOs like that very often. It's actually very rare to have, $100 billion company out of the gate. Pretty unique. That's in regard. That shows that companies can be extremely successful in the private domain and become a giant in the private domain and then go public. which makes a point very strong that companies are probably going to stay private longer, as everybody in this room will be part of providing liquidity to private entities this way or the other, retail, institutional, everything in between. Allow the companies and mostly shareholders liquidity. Companies were able to raise capital in the private market forever, right? VC funds were available starting the 60s to pretty much every good idea throughout the cycle. The problem was liquidity. Shareholders need to realize some sort of liquidity, and mostly that liquidity in most was not available only through the public market. I gave a presentation to the SEC in the summer, and I called that they actually should not fight liquidity in the private market for two reasons. A, they're probably going to lose that war. If there is a motivated buyer and a motivated seller, they will find a place to meet. And the SEC cannot do anything about that, and they need to realize that. The second is that by fighting liquidity, they actually cause companies to go public for the wrong reasons. Mm-hmm. Many times companies just went public because someone says to replace his Lexus, or a fund was coming due and A round or B round investors need to seek for liquidity. And then the company went public just to satisfy some liquidity needs. Mm-hmm. And my point to the SEC, you are not doing me a favor as Mr. Citizen by pushing companies, avoiding liquidity in the private market, pushing them to go public for liquidity. You don't do me any favor by doing that.
Great point.
And they said the same. They said, we never thought about it this way. But the point about Facebook, Facebook is a catalyst or almost a magnifier that shows that private is good. Tremendous opportunity are in the private space. It's an asset class, as we mentioned before. And there are many other opportunities and that will follow Facebook. Facebook is almost a trade that is over. At $100 billion today, it's about $80 billion in the marketplace. I wouldn't say it's fully valued, but it's getting there. Right. The question is, what will be the next Facebook? Is there a next Facebook in the pipeline? What happens when Twitter is going to be acquired? Probably will not go IPO, but will be acquired. Facebook will go public. And then what happens to the private market then? And we believe there is a tremendous opportunity for private companies and private transactions as we move away from Facebook becoming a public company pretty soon.
Great. Well, thank you guys so much. This was really incredible.